Welcome to this explainer, where we're going to put on our sell-side equity analyst hats and rigorously value a genuinely distressed asset based purely on its financial data. Today, we're taking a deep, clinical look at iSpecimen, trading under the ticker iSPC. Now, our job here isn't to get swept up in marketing materials or future promises. No, our job is to look at the cold, hard math. We are going to build a structural valuation framework using literally every piece of data available to us in the source documents.
Okay, let's dive right into this with a totally staggering number, negative 2,220%. You heard that right. This represents iSpecimen's return on invested capital, or ROIC. For anyone practicing fundamental valuation, you know ROIC is the master metric. It tells you exactly how efficiently a management team allocates capital to generate profitable returns. So a negative 2,000% return, that essentially means that for every single dollar put into this company's operating assets, wealth is being destroyed at an astonishing exponential rate. This single metric really sets the stage for our entire analytical exercise today.
And honestly, that wealth destruction is reflected across the board in their baseline financials. We're looking at a trailing 12-month net income of negative $10.48 million. The stock price? It's suffered a brutal 89% drop in trailing returns and is down nearly 46% year-to-date. Plus, the free cash flow yield sits at a really painful negative 70%. So we aren't just looking at a company experiencing a slight cyclical downturn here. We are evaluating an asset in a state of severe financial hemorrhage.
So, here is our analyst toolkit and our agenda for today. We'll cover the baseline reality, absolute valuation, sum of the parts limitations, relative valuation, asset liquidation, and then wrap it all up with our final synthesis.
Let's start with Section 1, the baseline reality.
The absolute central question we have to answer in this explainer is, how on earth do you value a company that just burns through cash? In traditional finance, right, an asset is only worth the present value of the future cash flows it can generate. But when the historical free cash flow compound annual growth rate over the last 3 and 5 years is dead flat at exactly 0%, and the trailing cash flow is deeply, deeply negative, well, traditional math starts to break down. Let's see how our models handle this reality.
Moving on to Section 2, absolute valuation.
To establish a baseline, we're going to compare standard discounted cash flow and adjusted present value models. Now, both of these rely entirely on discounting future free cash flows, whether we are calculating unlevered cash flows and WACC for a DCF, or, separating out tax shields from debt for an APV, we hit a massive roadblock. iSPC currently has a negative $5.2 million trailing free cash flow. Applying standard discount formulas to deeply negative numbers, it simply yields a negative equity value. There's just no way around it.
Because our source data lacks any forward-looking management projections and currently just shows massive cash bleed, we are absolutely forced to declare some required external assumptions if we want these absolute models to work at all. We basically have to assume a standard terminal growth rate of 2 to 3% and a market risk premium of 5 to 6%. But more importantly, we have to model a completely miraculous hockey stick turnaround in operating margins just to get positive cash flows in years 3 through 5. Without doing that, the DCF and APV models are mathematically unusable for establishing a current fair value.
Let's look at another angle and compare the residual income model against the dividend discount model. Residual income is often a great tool for distressed assets because it starts from the current book value of equity per share. But here's the catch. iSPC has a price-to-book ratio of 15.43. The market is inexplicably pricing the equity at over 15 times its accounting value. With massive negative trailing net income, subtracting an equity charge here just generates huge negative values, completely destroying any baseline book value we started with.
And as for the dividend discount model, yeah, it completely breaks down for iSPC. Our source data explicitly shows 0% dividend compound annual growth rate over the last 5 years. A multi-stage DDM requires a consistent, stated dividend policy to extract historical payout ratios and forecast future payouts. Since the input is exactly 0, the resulting intrinsic value derived from the DDM is, you guessed it, exactly 0.
Which brings us to Section 3, SOPP limitations. Theoretically, if a company operates distinct business segments with different risk profiles, we can just value each one independently and sum them all up. However, we are explicitly skipping the sum of the parts model today. Why? Because as strict analysts, we are bound by our source data, and the provided documents completely lack the distinct segment-level revenue, margin, and capital expenditure data required to calculate independent equity values. We just have to note this limitation and keep moving.
Let's try Section 4, relative valuation.
Here we run into another data constraint. The source documents fail to identify any specific peer companies. Therefore, we have to make a formal required assumption. To perform this valuation, an analyst would select publicly traded comparables, likely microcap biotech or medical specimen procurement firms, based on general industry knowledge. We'd extract their multiples, find the median, and apply it to iSPC to calculate an applied intrinsic value per share.
But look at these target metrics. They make this nearly impossible. The price-to-earnings ratio is negative 2.49. Enterprise value to EBITDA is negative 0.07. You simply cannot use negative earnings multiples to determine a positive share price. This forces us to rely heavily on the price-to-sales ratio, which is sitting at 3.83. But valuing a company purely on sales when its net profit margin is a staggering negative 266%, that is incredibly dangerous. It literally means every single dollar of sales generates massive losses. Okay, Section 5, Asset-Based Liquidation. This might be our best bet.
To calculate liquidation value and find a potential price floor, we rigorously follow 4 distinct steps. First, we restate the balance sheet to fair market value. Second, we estimate the net cash proceeds we would receive if all assets were just sold off for parts in an orderly liquidation. Third, we subtract all adjusted liabilities. And finally, we divide that remaining net asset value by the diluted shares outstanding.
Now, while the historical returns are disastrous, this actually realistically frames the liquidation context, and it's pretty fascinating. iSPC does actually have a zero debt-to-equity ratio. Its current ratio, which as a reminder measures current assets against current liabilities, is 1.12. This means it technically has enough short-term assets to cover its immediate obligations. This provides a tiny but critical glimmer of balance sheet stability against the microscopic $7.396 million market cap. Because the enterprise value is so incredibly low, an asset-based approach doesn't require a miracle. It just requires the physical and intangible assets to be worth a few $1,000,000 on the open market. Bringing it all together now in Section 6, our final synthesis. As you can see, the sheer distress of iSPC really forces our hand here. The discounted cash flow model requires practically unjustifiable assumptions of a sudden, magical return to profitability. The dividend model is entirely unusable. Some of the parts lacks the required source data. Therefore, from a strict fundamental perspective, we must rely almost entirely on asset-based liquidation models to find a theoretical floor for the share price, because the operations themselves are at this very moment destroying value.
So I'm going to leave you with a final thought directly from our analyst's desk. When a company posts a negative 99.9% return over 5 years, its operations have effectively failed the market test. So ask yourself, when looking at iSPC's zero debt and super low market cap, is its true fundamental value found only in selling off the furniture? It's a stark reality of equity analysis, but sometimes the numbers just speak for themselves. Thank you for joining me for this explainer, and remember to always keep questioning the data.